Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Mike 𝗔𝗕𝗄𝗯, provides you with insight and guidance on
Real Estate Radio Live, talking anything and everything real estate as we always do, providing you great information and education. We have a great show in store for you today. This is a topic that I don't believe we've discussed on the show ever or for a very, very long time. So Sean Buxton is here from Legacy Capital Group. He's a certified financial planner. Sean, how you doing?
Doing great.
Good. Thanks for coming in. And really the topic of today's show is what's called a Charitable Remainder Trust. And we're going to really dive deep into what that is. It's essentially a 1031 alternative, 1031 exchange, which I know a lot of you that listen to the show often have heard about, and we've had people on talking about that. This is a tax deferral strategy, so it's something probably a lot of you have not heard about before, and it's a really interesting topic. So hopefully you get a lot out of today's show. But just a reminder for those of you just tuning in, there's a couple different ways you can listen to the show. That is on the radio at 𝗘𝗀𝘁𝗁 1220 AM, or you can always go on online live, and you can go to 𝗟𝗡Radiolive.com, or you can download all the apps. We have an app. RE Radio Live has an app, KDOW has an app, or the iHeartRadio app. So if you haven't figured out a way to listen to us yet, then you're doing something wrong, because there's plenty of ways to do it. We're also on iTunes now, and we're podcasting every show. So after the show, we edit the show, and we put it up on iTunes, and so you can listen to all of our past shows there. Or if you want to listen to us live, we come to you 5 days a week, Monday through Friday from 3 to 4 p.m. with bonus coverage on Wednesdays and Fridays from 2 to 3. And also, we are a live show, and I'm sure you'll have some questions today on what a Charitable Remainder Trust is. And so you can call us at 1-800-516-1220, 1-800-516-1220, or you can go online to 𝗥𝗲𝗹 and you can click the Contact Me tab, and you can submit your question while we are on the air. So there you have it. Again, hope you guys all had a great Thanksgiving and the holiday weekend. And we're right in the thick of the holidays now. How was the holidays for you, Sean?
No, they were great.
Good.
Yeah, too much turkey,
that's
not
right.
enough time.
That's right, exactly. That's a lot of people's problem. So, all right, before we get into Charitable Remainder Trust, give us a little bit of background on yourself and a little bit of info on Legacy Capital Group and all that good stuff.
So Legacy Capital Group, I guess I'll start there, is a fee-based financial planning firm, been in existence for over 25 years. Myself, I've been in the financial services industry now for about 13 years. Local Bay Area guy, went to high school at 𝗥𝗱𝗏𝗏, started out doing my own investing in college, turned that into an economics degree, and started actually at a 𝗟𝗡𝗏𝗡 over in the prune yard.
Nice.
In 2003, and I've been working really with high net worth individuals and closely held businesses since.
Yeah, and moved your way back to 𝗥𝗱𝗏𝗏, which is where Legacy Capital
Slowly
Group
but
is.
surely.
Yeah, we're a couple blocks away from each other where our offices are, and again, so Charitable Remainder Trust. I mean, Legacy obviously does a lot of different things at your guys' company, but we've decided to talk about this today because you and I we've talked a lot of tax deferral strategies, particularly as it relates to real estate and sales of real estate, and that's really how we're going to wrap it in today to Real Estate Radio Live. So let's start off with the general definition of what a Charitable Remainder Trust is.
Mm-hmm. Yeah, no, it's well titled in the sense that it is a charitable remainder trust. So first off, it is a trust. It's an irrevocable trust that you would put a piece of property into.
Yeah.
And at the end of the day, there's going to be a charity that's going to receive the remainder of the assets.
Right.
So that's kind of really high level. Well, why would someone put their assets inside of an irrevocable trust of which a charity is going to get at the end of the day?
I'm sure that's the first question everyone thought of when you said that. So let's definitely talk about that.
Yeah, so the main reason, as you discussed, is tax deferral. So you are able to put an asset, let's say a building, inside of this charitable remainder trust, and you can sell that asset inside of the trust without triggering a taxable event.
Right.
So if you had a property that had had been depreciated, essentially down to zero, and had a ton of long-term cap gains in it, a charitable remainder trust might be an alternative that you would want to consider.
So how exactly does that work? I know we're going to get into a couple of examples later, so I don't want to jump the gun yet, but so getting it into the trust. So let's say, for example, somebody has a, fourplex, all right, and they want to put it in this charitable remainder trust. So what's the process of doing that, and what does that look like, and why is that going to be beneficial for somebody?
Yeah, exactly. So most oftentimes, the reason that someone's going to be doing something with or looking at a charitable remainder trust is because they're thinking of doing something with that property, right? They might be looking at a 1031 exchange. They might be looking to sell the property, and then a CRT might be something that they want to consider. So you would want to look at it in terms of what's going to result in the most net dollars in the client's pocket. That's what we look at. Yeah. So if you took this property and you sold it and you paid all of this tax on the sale, and then you go out and you do what with it? Well, you need to reinvest it in something else, maybe another piece of real estate, maybe a bond portfolio, what have you. Well, what does that look like in terms of in terms of net dollars to the client versus if they put the property inside of the charitable remainder trust, where they can sell that asset and not pay any tax on it, and now money that would have gone to tax they can put in that bond portfolio and drive income for themselves. So I think the high level, a good way to think of the CRT and where it's appropriate is if you are looking to basically create a pension plan for yourself. The CRT can do that because the structure of it is it's going to drive income to you during your lifetime, or if you're married, you can set it up so that it goes to the end of both of your lives, so the last surviving spouse. Yeah,
no, it's great, and if you're out there listening, this is not in my opinion, it's not an easy really concept to get right off the bat, right? You're explaining it well, though. I'm not saying that, but it's basically what we're looking at is we've had guys on the show talking about 1031 exchanges, and so let's say you have an investment property. You sell the investment property, and you can 1031 exchange that into another like-kind property, another like investment property. So if a rental property for a rental property or fourplex for a rental property, whatever. What you guys really do with the charitable remainder trust is you take this asset, you put it inside of the trust, and then by doing that, you can now sell it, take the proceeds from that, and you do you 1031 exchange that into bonds, or it just gets rolled into that?
No, just once the asset's inside of the trust, you can then sell that asset inside of the trust, and it's not going to be a taxable event. The taxable event is going to begin when you start taking distributions. Okay. And easy way to think of it is you're going to be taxed at whatever rate you would have been taxed at had you not done this. So what you're able to do is you're able to play with tax dollars for a longer period of time and defer that tax event into the future, which is always an advantage to you.
And I think that's always something to reiterate when you're talking about tax deferral strategies, like with anything, charitable remainder trust or 1031 exchange, it's a tax deferral strategy. Right. You're never going to get away with paying the piper. It's just going to happen further down the road, right?
Exactly. And then if you take an example of where you had $1 million property and you were going to pay $400,000 in long-term cap gains, let's say, you have the ability to do something with that $400,000 and make money off of it before you have to pay that to the government, and that's the
before you do or or whoever inherits it does, right?
Mm-hmm. Well, once it goes to the end of the day, when it goes to charity, that'll be a tax-free event, so the charity won't pay any tax.
Got it. And I'm sure we'll get to that a little later. Yeah. But on the tax incentive note, and by the way, if you're just tuning in, we have Sean Buxton, a certified financial planner with Legacy Capital Group in studio today, and we're talking about charitable remainder trust. If you don't know what the heck that is, you definitely need to stick around and listen to the show. It's a really interesting tax deferral strategy. If you have any questions for Sean or myself, 1-800-516-1220. 1-800-516-1220 is the number, and we're going to give out Sean's info at the end of the show, and some other good stuff. So on the note of tax incentives, okay. So one of the main ones you're talking about, I know there's a couple, so let's get to that. So one of the main ones, obviously, is by just straight up selling a property not in a trust or anywhere you pay capital gains on it. So I guess one of the first ones is you avoid that with a charitable remainder trust,
Correct.
right? Okay. What other tax incentives are there with a CRT?
Yeah, so the other big one is that when you contribute this asset to the trust, you're essentially making a donation to a charity. Although it's not today, it's going to be at the end of your life.
Yeah.
So it's not, if you put $1 million inside of a CRT and you live for an additional 30 years and you take income off of that, well, the value and the remainder asset is going to be much smaller than that million because you're going to have spent a lot of it, right?
Yeah.
So there's a formula for calculating that, and you do get a deduction, let's just say, in the 10 to 20% range on average. It's going to vary depending on how you set it up, and you're in control of that. But if you put $1 million inside of a CRT, you might get $100,000 or a $200,000 deduction today that you can offset against income.
Okay. What do you say, and maybe I know we have a lot to get to, but what do you say to a client that has heirs or has kids, or what do you say to kids, I guess, is the question, because I don't know if I'm sure we're going to get to that, but I want to get to it now because it's kind of an interesting concept. Is you have a client with multiple kids and they have these assets that, I'm sure the kids assume they're going to get at some point. Mm-hmm. So how do you talk to a client like that about putting it into the CRT, which is essentially going to be given to a charity as opposed to the kids at some point, right?
Yeah.
So what do you say to them?
I just prefer not to talk about that.
Yeah, exactly.
No, it's really actually these aren't – a CRT is not going to be a strategy for a guy who has maybe the 1-4plex as an example, and that's the bulk of the assets that the kids are going to be inheriting. They're most likely going to have a few different things going on, and the reality is these are clients that are going to spend $100,000, $200,000, $300,000 maybe a year in retirement. So what we're just looking at is, do we shuffle around the furniture in the room, and instead of taking money from the IRAs over here and pulling off of the portfolio, do we do it from the CRT?
Right. I definitely want to talk about that a little bit more with the heirs, but we got to take a quick break. God, that went fast. 1-800-516-1220 is the number if you got any questions for Sean or for myself. We are talking Charitable Remainder Trust on Real Estate Radio Live. Again, the number 1-800-516-1220. I'm Mike D'Ambrosio. This is Real Estate Radio Live. Stick around. We'll be right back. D'Ambrosio on Real Estate Radio Live, KDOW 1220 AM. We have Sean Buxton in studio today, certified financial planner with Legacy Capital Group, and we're talking about Charitable Remainder Trust. And this is a tax deferral strategy I'm sure many of you have not heard about before. So super excited to have Sean on today. Love to hear from you guys. If you have any questions for Sean or myself, 1-800-516-1220. And this segment is brought to you by Giorgio's Italian Food and Pizzeria and Frankie, Johnny, and Luigi's too. The best Italian food around with 4 convenient locations throughout the Bay Area to serve you. You can go to Giorgio's and fjlitalian.com for more info on their famous happy hour specials. All right, Sean, let's get back into it because we got a lot to get to. So Charitable Remainder Trust, or CRTs as we've been referring to them as well. Again, a tax deferral strategy. You can sell a property, put it within a charitable remainder trust, and make the money work for you. So the question I asked you before we got we took a break was if someone has heirs. So how do you get past that how do you get past that?
Yeah, we just run the numbers. That's really what Legacy does for clients is we do an analysis and we look at what if you did the CRT and model that out and look at what is the effect on the estate at the end of the day, having done it this way versus the other way. And most oftentimes what we find is that because of the tax advantages of the CRT, it's more efficient to actually drive income and more income from that asset and then leave other assets alone.
Yeah.
So the net effect of the estate is minimal or might even be improved where the kids get more money having done the CRT than having not done it. And then in a real worst case scenario, the client can always purchase a life insurance policy to replace the estate.
Right.
So Legacy's done about 150 CRTs. I would say about 20% of clients choose to purchase an insurance policy to replace some of or all of the asset that went into the CRT. So it's more rare than not.
So essentially, what you're saying is, and you did say this on the other segment is don't put all your eggs in one basket, essentially, with the CRT, especially if you have, a client with a lot of kids that are expecting to inherit things.
Yeah, this is definitely not a strategy that's for everyone.
So let's talk about that really quick. We want to talk about the need, and so where does this strategy come from, and what is the need for this for certain people?
Yeah, well, definitely I'll try to keep it tied specifically to real estate assets. And what we've seen a lot of is clients who have owned properties in the Bay Area since, let's say, the 80s, early 90s, and those properties have appreciated tremendously in value. They've also
certainly have.
They've also depreciated their basis down to zero,
right.
and now they're looking at their cash flow relative to their equity, and they're saying, well, I'm getting maybe 2% on my money. I can't sell this thing. I'm going to get killed in taxes. Do I do a 1031 out of state? Well, I'm at this point in my life where I don't really want to deal with the tenants' toilets and trash. And even if I have a property manager and a property out of state, what else can I do? And that's where the CRT might play into that particular client.
There's a lot of, we've had many conversations about this, is how many people there really are in the Bay Area that could be looking at a situation like this where they've owned a property, and this is people that I love to help. They've owned a property for 10, 20, no, more like 20, 30 years, maybe a condo or a townhouse or a single family they bought for a couple $100,000. Now it's worth $1 million, and the money is not working for them the way it used to. They've depreciated it. Do they want to buy another, rental property and deal with all the problems with that? Or can they put it in this charitable remainder trust and let the money work for them, essentially? That's really what we're looking at, right?
Yeah, and you structure the CRT. It's your trust. So you're going to set the income that you're going to take out of it at the end of the day. And there's some limits to what you can do.
Yeah.
But, theoretically, you're going to say, hey, I'm going to take a 10% payout on these assets. I'm going to take 5% per year for the rest of my life, and that's what you're going to do.
Yeah. And really it helps you from an income standpoint, generate more income. Maybe you could get more income with the CRT than you had with that real estate property that you put into it, right?
Yeah, absolutely, especially if you're considering selling that property, and now in California our highest long-term cap gains rate is 37%.
Yeah, no, and that is not fun writing that check to the government. So anyways, we got a lot more to get to. 1-800-516-1220 is the number. Sean Buxton's on today, certified financial planner with Legacy Capital Group, and we're talking about Charitable Remainder Trust, a great tax deferral strategy. 1-800-516-1220 is the number. I'm Mike D'Ambrosio on Real Estate Radio Live. Come back in. This is Mike D'Ambrosio on Real Estate Radio Live, KDOW 1220 AM. We have the pleasure of having Mr. Sean Buxton in studio today, the certified financial planner with Legacy Capital Group. We're talking about Charitable Remainder Trust, and I'm sure a lot of you may have never heard of these, and it's definitely a different tax deferral strategy and something we're learning a lot about today. If you have any questions, 1-800-516-1220. And this segment is brought to you by Taps Termite, serving the Bay Area for over 45 years. Taps Termite is committed to keeping your living area pest-free by using the newest and safest technology. You can call them today for a complimentary inspection, 408-259-5900. All right, so Charitable Remainder Trust, Sean, we've getting a lot of info out there. Again, just kind of an overview. This is a quick segment. Talk again about tax incentives and financial planning incentives too. And then next segment, we're really going to walk the audience through an example, basically. So again, tax incentives, avoiding capital gains tax on a normal sale. What other ones are we looking at? And then what are the financial planning incentives for someone doing this as well? Yeah,
and I'd love to say everyone comes to us with it's really charitably inclined, and they're thinking of society in a greater sense. But most of it is exactly as you said. There's tax incentives, and it's about net dollars in the client's pocket ultimately at the end of the day. So the big boys are avoiding capital gains tax on the sale. So that's easily the biggest. And then
biggest reason.
Yeah. You're selling a $5-10 million property.
Yeah.
And you're looking at a 40% cap gains hit on that. That's a big number, right? So you can use those assets to grow and drive income to you over your entire retirement. That
Absolutely.
makes a big difference. And then the deduction up front is pretty big too, and can be depending on the age of the client. So it could be anywhere between 10 and 50% deduction of what you put in there.
Okay.
Which is really big. And then ultimately, estate tax a lot higher now, but that does come into play. If you have an estate over $10 million, moving this asset to a CRT is going to remove it from your estate and taxable estate. So that's a way to reduce the amount of money going to the government.
Absolutely. What types of charities can, I guess, be the beneficiary of I mean, is there any restrictions on that, or what is?
There's
what is
really
that?
not. I mean, any charity, 501c3 organization can be designated as a beneficiary of the trust, and then you can even do donor advised funds too, which is a way that the family, so the heirs, could potentially still be involved, right? Where they're then working with a community foundation and picking then the various charities and causes that they want money to go to.
So that's one that if you have heirs that are on board with the whole charity aspect of it, that's one way to get them more involved after, God forbid, pass away, and then this thing gets reverted to that, right?
Yeah,
so
absolutely.
Yeah.
And there's hedges against that too. So you can put a period of time on the CRT that it's going to pay no matter what. So you could put 20 years as a period certain on the amount of time that the CRT is going to pay you. And so it would be the longer of your life for that 20 years. So if you walked out tomorrow both and you're married, you and your wife got hit by a bus, the CRT would continue to pay out to the kids for 20 years.
Okay, gotcha.
It would just reduce your deduction that you would get up front.
Okay, got it. So, again, I mean, I think the biggest thing on this is the capital gains. Obviously, that's the biggest one that probably in everyone's mind is when they're deciding whether or not to sell a property is how much am I going to pay on that sale?
Yeah, and it ultimately just becomes a math problem.
Yeah, absolutely. All right, well, we're going to walk you, speaking of a math problem, we're going to walk you through really an example on the next segment, so you definitely want to stick around. Sean Buxton, a certified financial planner with Legacy Capital Group, is in studio today. We are talking about Charitable Remainder Trust. That's CRTs. Having a good time? You got any questions? 1-800-516-1220. I'm Mike 𝗘𝗀𝗎. This is on Real Estate Radio Live, KDOW 1220 AM. We have Sean Buxton in studio today, the certified financial planner with Legacy Capital Group, and we are talking about Charitable Remainder Trust. And this is a tax deferral strategy, folks, and it's a 1031 exchange alternative essentially. So we are telling you something a little bit different today. And if you got any questions, for Sean or myself, 1-800-516-1220. And this segment is brought to you by 𝗥𝗲𝗓 Construction. They have been serving the Silicon Valley for over 40 years. You can visit them today at starburstconstruction.com. That's Starburst, like the candy, starburstconstruction.com. All right, Sean, so let's walk through an example of the CRT, Charitable Remainder Trust, and really kind of dive into how this works in a real lifetime example.
Yeah, so you've got a property, and let's say that property's worth $10 million.
Okay.
And you are looking at what your options are, and you decide that a CRT is going to be the route to go. So one of the things that is really important is that you cannot have already listed this property to be sold and engaged in a contract to sell that property.
Okay.
So that's if you've already gone down that road and you have a pending sale, you can't go back. So CRT is something that you want to do the planning up front, look at it before you get to that point.
Quick question: if it's already in like another trust, like just another type of trust, can it be brought into a charitable remainder trust?
It depends. That's my economic answer for
you.
All right,
okay.
So
call you if you want to talk about it, right?
Yeah,
okay.
So most likely, if it's a revocable trust, it's a non-issue, which I think is what you're probably referring to, like a family trust or something like that. Yeah.
Okay.
If it's another irrevocable trust, you might have some issues with that.
Got it.
But assuming it isn't, you put the asset inside of the CRT.
Okay.
You then list that property for sale, so the CRT is actually now selling this property.
Okay.
Right?
Yeah.
And the CRT is in ownership of that property. Once the property is sold, the CRT is going to receive the proceeds of that sale.
And really quick, just to clarify, so it's in the CRT. The original owner now becomes I would assume, the trustee of the CRT.
They will be the income beneficiary.
Yeah, and they will be signing the paperwork and signing the documents. Just as if they own it, it's just under a different name, essentially.
Yep,
okay.
Exactly right.
Go ahead.
And so then that property sold, they're not going to owe any tax on sale. And they're also going to receive a deduction based upon the value of that property when it went into the CRT. So high-level purposes, there's a little bit of complexity around that, but assume the price you sold it at is a fair market value for the property.
Okay.
So if you sold that property at $10 million, depending on how you structure the CRT, you would be getting a deduction between 10% and maybe perhaps as high as 50%.
Wow.
On that $10 million. So,
for what is there a reason behind that, or is that just the way it's structured?
So you are, in essence, making a contribution to a charity.
Yeah. Okay.
So when you do that, you receive a deduction for it. Unique to the CRT is you're saying, hey, Mr. Charity, I'm not going to give you $10 million today. What I'm actually going to do is use that $10 million to live off of, but as soon as I'm dead, I'm going to give you the remainder.
Right.
And so what you look at is what's the value today of receiving a gift in the future.
Got
and
it.
So there's a calculation that you can do to do that.
Got it. Okay. So then what happens after that? What happens next? After you sell it, you put it into the CRT, you get the deduction from the IRS.
Yep.
You don't pay any other capital gains taxes. So okay, so now you're sitting in this charitable remainder trust. Then what happens?
So you're now in exactly the same position that you would be in if you sold the property outside of the CRT, except that you now have a lot more money to play with, and you also have a deduction that you can use to offset the taxes that you would owe on income coming out of the CRT or perhaps other income that you have. So you would structure a portfolio, so to speak, for those assets.
Yeah.
And that
with a financial planning firm like you guys, like Lacey Capital Group, and you.
Absolutely.
Okay.
And you can invest in, pretty much anything you want inside of that CRT that you could do outside of. So stocks, bonds. You could do asset-backed lending, really anything that's arm's length transaction.
Okay. Could you buy? Would you be able to buy other property with that, or?
Yeah. So the way that you would really look at doing that would be to actually use the income coming out of the CRT to pre-qualify you for that next property.
Okay.
So that would be if you're looking to acquire additional property, I think that's the best way to do it. You sell the property inside of the CRT. Now you have an additional income stream on your balance sheet that's going to be coming in, and you're going to use that income to qualify and then fund to fund the note service.
Okay. And then anything that happens next, we just got another minute and a half. But anything after that, as far as the process goes?
So then the structure is you've got this $10 million, let's say, inside of the CRT, and then you actually would set the payment that you would be receiving for the rest of your lifetime, and that's going to have an effect on the deduction. So it makes sense. The higher the payment you want, the less the charity is going to receive at the end of the day. So the less the deduction.
Yeah.
If you take a lower payment, you can receive a higher deduction.
Right.
Because theoretically, the more the charity is going to receive at the end of the day.
Yeah. And can you you can't adjust that at any time? I mean, due to cost of living or anything like that?
No. So that's going to be set. So you're going to set that when you create your CRT. So that's where, when we do the analysis on the front end, we're looking at that. Is the income stream more valuable to you? Do you need the deduction?
Right,
Can you use the deduction? There's a finite amount of time that you have to use the deduction in. You've got to use it in 6 years. So that all plays into it.
Yeah. Really quick, in 20 seconds, anything negative with it? I mean, everything sounds pretty... If it's the right fit for somebody, anything negative with the CRT?
Yeah, I mean, there's illiquidity to it, right? And you're taking this asset out of the estate. So that's where I say it really has to be a good fit. But no, if a CRT is a good fit for the client, it does look great.
Yeah.
And that's why a lot of people do them.
Absolutely. Yeah, we've looked at a few together, and it's definitely a good-looking tax deferral strategy if it's the right person, right fit. Anyways, we're going to wrap up the show on the other side, and if you got any quick questions, 1-800-516-1220. Sean Buxton, a certified financial planner with Legacy Capital Group, has been in studio today. I'm Mike 𝗔𝗕𝗓𝗡 on Real Estate Radio Live. Stick around. We'll be right back to wrap up the show.